everyone, and welcome back. Today we're diving deep into The Simple Path to Wealth by J.L. Collins.
Great pick.
It's a classic in the personal finance space, and for good reason.
Yeah, definitely.
It's approachable, it's easy to understand, and it really breaks down these sometimes complex financial concepts in a way that anyone can grasp.
Totally agree. I love how it's written as a series of letters from a dad to his daughter. You can really feel that genuine desire to educate and empower.
Yeah, it feels very personal.
Yeah.
Like you're getting advice directly from a mentor.
Exactly. And he doesn't sugarcoat things either.
Uh-huh.
He tells it like it is, which is refreshing.
Yeah, he definitely doesn't beat around the bush. And one of the first things he tackles is debt.
Ugh, debt, the dreaded D word.
Right. He calls it a vicious, pernicious destroyer of wealth-building potential.
No kidding. It's like this weight that holds you back from achieving your financial goals.
Exactly. And he even shares this anecdote about a $300 credit card bill
Oh, I remember that story.
with an 18% interest rate.
Oof, 18%. That's brutal.
Yeah, it really illustrates how quickly debt can spiral out of control.
It's a slippery slope for sure. But what I appreciate is that he doesn't just leave you with a sense of doom and gloom.
No, definitely not.
He offers practical advice on how to tackle debt based on interest rates.
Right. Prioritize the high-interest debt first, like the 18% credit card, because that's the stuff that's really costing you money.
Exactly. And then once you've got that under control, you can start chipping away at the lower interest debt more gradually.
It's all about having a plan and being strategic.
Right. Absolutely. And this ties into one of my favorite concepts in the book, FU money.
Okay, FU money. That's a powerful term. What exactly does that mean?
Well, it's not about being rude or disrespectful. It's about having enough financial security to make choices without being chained to a paycheck.
So it's about freedom.
Exactly. Freedom to walk away from a job you hate.
Oh, I like that.
Freedom to pursue a passion project.
Yeah.
Freedom to say no to things you don't want to do.
It's about having options.
Precisely. And Collins illustrates this beautifully with a story about being laid off after 9/11.
Right, and his daughter asking if they were poor.
Yeah, and his response was brilliant. He said, nope, we have money working for us.
That's such a powerful message. It's not just about how much money you have. It's about having your money work for you, giving you that peace of mind and security. So it's about having that financial cushion, that FU money, that allows you to live life on your own terms. Now, with all that said, can anyone retire a millionaire? Collins actually poses that question in the book.
He does, and it's a fascinating one. I mean, we often think of becoming a millionaire as this distant dream.
Yeah, like it's only for a select few.
Right. But Collins breaks down the math and shows that it's actually more attainable than we might think.
Okay, I'm intrigued. Break it down for us.
He uses this example. If you had invested just $12,000 in the S&P 500 back in 1975.
Wait, just $12,000?
Yep, you heard that right. Just $12,000 in 1975 would be worth over $1 million today.
Seriously?
Yeah, it's mind-boggling, right?
Yeah.
But it highlights the power of compound growth over the long term. However, and this is a big however, while it's mathematically possible, Collins also acknowledges that most people don't reach millionaire status.
Why is that? If it's mathematically possible, why isn't it more common?
It's a great question. And Collins points to a few key factors. He talks about societal pressures to keep up with the Joneses, the constant bombardment of advertising encouraging us to spend, you know?
Oh, yeah, definitely. I see that all the time. It's like this never-ending cycle of wanting more, buying more, and then needing to work more to pay for it all.
Exactly. It's a trap that's easy to fall into. But what Collins emphasizes is that mastering your money isn't just about earning more.
It's about being intentional with your spending.
Exactly. It's about aligning your spending with your values.
Right. It's not about depriving yourself. It's about making conscious choices about where your money goes.
Absolutely. It's about focusing on what truly matters to you and aligning your financial decisions with those values.
That makes so much sense.
It's not just about the numbers. It's about living a life that's aligned with what you truly value.
So we've covered a lot of ground in this first part, tackling debt, the importance of FU money, and the idea that mastering money is about intentionality, not just income.
It's about building a solid foundation for a financially secure and fulfilling life.
Exactly. And with that solid foundation, we can move into the heart of Collins' investment strategy, the stock market.
The stock market can seem intimidating, but Collins has a way of making it approachable and understandable.
Okay, I'm ready to hear more about this, but first, a quick break.
All right, so we've laid the groundwork, talked about getting out of debt, building that solid financial foundation, right?
Right, that FU money cushion.
Exactly. Now let's dive into the heart of it. How to actually make that money grow, how to put it to work for you.
The million-dollar question.
Well, Collins makes a pretty compelling case for the stock market.
The stock market. Okay, I'll be honest.
Yeah.
That whole thing kind of freaks me out a little bit.
I hear you. It can seem like this big mysterious casino where everyone's speaking a different language.
Exactly. And you never know if you're going to win or lose.
Right. But Collins does a fantastic job of, first of all, demystifying it,
Well,
taking away that fear factor.
Okay, good, because I need some of that.
And his core message when it comes to the stock market, it's surprisingly simple. Over the long term, the market always goes up.
Wait, hold on. I hear you, but I also see the news, right? The ups and downs, the crashes, the times when it feels like everything's going down the drain.
You're totally right. It's not always smooth sailing. That's where his analogy of beer and foam comes in, which I love.
Beer and foam. Okay, I'm listening.
So imagine a glass of beer. The beer itself. That represents the underlying value of companies,
Gotcha.
the real engine of growth in the economy,
Okay.
driven by things like innovation, productivity,
Yeah.
the actual stuff that makes our world go round.
All right, yeah.
Now, the foam,
Yeah, the foam.
that represents all the short-term stuff, the daily ups and downs, the things that make people panic, the emotional roller
The
coaster.
things that freak me out, yeah.
Exactly. It's driven by speculation, emotions, all the noise in the market. But here's the thing. If you focus on the beer, the long-term value, you can ride out those foamy fluctuations and come out ahead.
So ignore the hype, focus on the fundamentals. Okay, that makes sense intuitively, but is there data to back this up?
Oh, absolutely.
Yeah.
Collins points to historical data. For example, the Dow Jones chart from 1900 to 2012. Even with all the crashes, the recessions, the world wars, if you look at the overall trend, it's undeniably upward.
Huh.
A market has always recovered and gone on to reach new highs.
Mm.
It's about playing that long game, remembering that the beer, that underlying value, tends to prevail.
So you're saying we don't need to be day trading, trying to time the market perfectly.
That's actually one of the biggest misconceptions Collins tackles head on. He calls that trying to outsmart the market.
Yeah.
He says it rarely works.
Yeah, well, that makes me feel a little better because I certainly don't feel like I can outsmart the market.
Right. And he even cites research showing that most active fund managers, the pros, the people who do this for a living, they don't actually beat the market over the long term.
Huh. Really? So what's the alternative? If trying to outsmart the market is a recipe for, well, not winning, what are we supposed to do?
Simplicity, my friend. Collins is a huge advocate for what he calls lazy investing.
Lazy. I like the sound of that already.
Right. Specifically, he loves index funds, particularly Vanguard's Total Stock Market Index Fund, VTSAX.
Okay, so lazy investing, VTSAX. Break it down for me.
Okay, so instead of trying to pick individual stocks, trying to time the market perfectly, which is basically impossible, you invest in a broad market index fund like VTSAX.
Okay.
This essentially buys a tiny piece of every company in the stock market.
So you're automatically diversified.
Exactly. You're not betting on any one horse, you're betting on the entire race.
Okay, that does sound a lot easier, I have to admit, and less stressful.
Exactly. And because these index funds are passively managed, meaning they just track the market, they have super low fees.
Which means more money in my pocket, right?
Exactly. More money working for you, compounding over time.
Okay, so this is all starting to sound pretty good, I have to admit.
Right.
But what about those inevitable market crashes? You know, those big, ugly events, as Collins calls them. The 1929 crash he talks about, that's scary stuff.
Oh, absolutely. And he doesn't sugarcoat it. He acknowledges that those crashes, those economic crises, they're a normal part of the cycle.
Normal? That doesn't sound very normal.
Normal in the sense that they happen, we just don't know when or how severe they'll be.
So how do we prepare for them without completely freaking out?
First, remember that beer and foam analogy. The market is always recovered from those crashes.
Okay, yeah, true.
Second, and this is interesting, Collins actually says a crash early in your investing life can be a good thing.
Wait, a good thing? How is that possible?
Think of it like a massive sale on your future wealth. You're buying stocks at a discount.
So those dips in the market, that's our chance to buy low.
Exactly. And then hopefully ride it back up when the market recovers.
Okay, I never thought about it like that. So market crashes, while scary, they're a part of the journey.
Right. And by understanding that they're a part of the journey, we can approach them with less fear and maybe even a little bit of, dare I say, excitement.
Excitement might be pushing it, but I see your point.
Right.
Now, you mentioned hyperinflation before. He talks about that too, right? Rapid, uncontrollable rise in prices. That's got to be bad news for our investments.
Absolutely. Hyperinflation is a serious concern, but Again, Collins argues that stocks, over the long term, offer a hedge against inflation. They've historically outpaced inflation, even during tough times.
Okay, so even with those big, ugly events, even with the threat of hyperinflation, Collins seems to be saying don't panic, stay the course, trust the process.
That's the gist of it, yeah. He's
Yeah.
all about tuning out the noise, sticking to the fundamentals, that long-term perspective.
Okay, so we've talked about the power of index funds, writing out that market volatility, not panicking when those big, ugly events inevitably happen.
Right, right.
But now let's get practical. How do we actually build a portfolio using this simple path approach? Where do we even begin?
Well, Collins lays out two main strategies, and they're kind of tailored to where you are in life. So there's the wealth accumulation portfolio, which is more geared towards younger investors.
Okay, so that's for folks who are just starting out, maybe.
Exactly, yeah.
Yeah.
And then there's the wealth preservation portfolio, which is more for those who are closer to retirement, maybe looking for a little more stability.
Okay, so two different approaches depending on your time horizon.
Exactly.
Got it. So let's start with the wealth accumulation portfolio. I'm still early in my investing journey, so this one definitely applies to me, I think.
Right, so this strategy is all about maximizing growth potential. It's about taking advantage of that long time horizon you have ahead of you.
Okay, so we're talking about being a little more aggressive, maybe.
Exactly. And you know what? The beauty of this strategy is its simplicity.
Oh, I like simple.
Right. Collins basically says put all your investment eggs in one basket, and that basket is VTSAX, that total stock market index fund we talked about earlier.
Really? All in on stocks? That seems, I don't know, a little scary.
It does, and it's not for everyone, I'll be honest.
Okay.
But the idea is, with a long time horizon, you have time to ride out those market fluctuations, those inevitable dips, and capture that long-term growth potential of the stock market.
So you're saying embrace the volatility, don't fear it.
Exactly. Embrace the beer and foam, remember?
Okay, yeah, I'm starting to see it. But I imagine it takes a certain kind of investor to go all in on stocks, especially knowing those big, ugly events are out there lurking.
You're absolutely right. It's not for the faint of heart. You got to have a strong stomach, be able to stay focused on the long game, not panic and sell everything when the market takes a tumble.
So what about those of us who are a little closer to retirement, maybe have a lower risk tolerance? What's this wealth preservation portfolio all about?
Right, so this strategy introduces the concept of asset allocation, which basically means balancing your investments between stocks and bonds.
Okay, bonds, I've heard of those, but to be honest, I'm not entirely sure how they work.
So think of bonds like loans you're giving to the government or corporations.
Okay.
And they tend to be less volatile than stocks, meaning their prices don't fluctuate as dramatically.
So a little bit of a safer bet.
In a way, yeah. They can provide stability, especially as you get closer to retirement, and maybe don't have as much time to recover from big market swings.
So it's about finding the right balance for your own risk tolerance and time horizon,
Exactly. Collins doesn't give a one-size-fits-all prescription.
which makes sense because everyone's situation is different.
Right. He encourages readers to really assess their own risk tolerance, their investment goals, how much effort they're willing to put into managing their portfolio, and then find a balance that works for them.
And he does mention those target retirement funds, right? The TRFs, I think he called them.
Oh yeah, those are great, especially for folks who want to keep it super simple.
So basically, you pick a fund that's aligned with your estimated retirement year, and the fund managers take care of the rest.
Exactly. They handle the asset allocation for you, automatically adjust the balance between stocks and bonds as you get closer to retirement.
So it takes the guesswork out of it, which I imagine is appealing to a lot of people.
Totally. It's a set it and forget it approach to investing.
I like it. Now, regardless of which portfolio strategy you choose, Collins is a big fan of investing with Vanguard. Why is that? What's so special about Vanguard?
It comes down to their unique structure. Vanguard is owned by its fund investors.
So it's like they work for us, not the other way around.
Exactly. Their interests are aligned with yours, which translates to lower fees, and that's huge.
Because lower fees mean more money in our pockets, right?
Exactly. More money working for you, compounding over time.
I'm starting to see a theme here. Keep it simple, keep it low cost, and focus on the long game.
You're getting it. Collins would be proud. Now, speaking of keeping more money in your pocket, we got to talk about taxes.
Oof. Taxes, the other dreaded T word.
Right. No matter how much money you make, it seems like the tax man always wants his cut.
Tell me about it. So how do we navigate this whole tax situation when it comes to investing?
Well, Collins is a big advocate for maximizing tax-advantaged accounts, things like 401ks, IRAs, Roth IRAs.
Okay, I've heard of those, but I'll be honest, all those acronyms start to blur together after a while.
It can feel like alphabet soup, I know. But think of them as different buckets you can put your money into.
Buckets. Okay, I'm intrigued. Tell me more about these buckets.
So you've got your traditional 401k and IRA buckets. With these, your contributions are tax deductible, which means you get a tax break now.
Ooh, I like the sound of that.
Right. The money grows tax deferred, but you will pay taxes when you withdraw it in retirement.
So it's like delaying those taxes.
Exactly. Then you've got your Roth IRA bucket. With this one, you contribute after-tax dollars.
So no immediate tax break.
Right. But here's the kicker. Your withdrawals in retirement are tax-free.
Oh, wow. Okay, so it's like choosing whether to pay taxes now or later.
Exactly. And the best choice for you depends on your individual circumstances, your income level, your tax bracket, all sorts of factors. But the key is to be strategic, to use these tax advantage accounts to your advantage.
It's like playing a game of financial chess, planning your moves carefully to minimize your tax liability.
Exactly. And speaking of planning ahead, we got to talk about those required minimum distributions, the R&Ds.
RMDs, right? I remember you mentioning those earlier. Those are the withdrawals you're required to take from your retirement accounts once you hit a certain age.
Right, you got it. Age 70, 12, to be exact.
And we'll have to pay taxes on those withdrawals, right?
Unfortunately, yes.
Yeah.
But don't worry, Collins provides some tips on how to minimize that tax hit, such as strategic withdrawals before age 70, 12, Roth conversions, things like that.
Okay, so there are ways to strategically manage those RMDs and potentially reduce our tax burden.
Exactly. It's all about planning ahead and being proactive.
Got it. So we've got our investment strategy. We're maximizing those tax-advantaged accounts. We're even thinking about RMDs. Anything else we should be thinking about in terms of our financial well-being?
Well, Collins also highlights the importance of health savings accounts, HSAs, especially if you have a high deductible health plan.
HSAs, right. I'll admit, those always seemed a little confusing to me.
They can be, but they offer some really awesome tax advantages.
Oh, like what?
So contributions are tax deductible, the money grows tax deferred, and withdrawals for qualified medical expenses are tax-free.
Wow, that's a triple tax advantage.
It is. And you could even use HSA funds for dental and vision care, both now and in retirement.
Okay, so HSAs, definitely worth looking into. Got it. So let's fast forward a bit. We've followed the simple path, invested wisely, taken advantage of all those tax benefits, and now that beautiful day arrives, financial independence.
Time to celebrate.
Right. But once we've achieved that financial freedom, how do we actually start enjoying it? Without outliving our money, of course.
That's the million-dollar question. And Collins introduces us to the famous 4% rule.
4% rule.
Yeah, basically it suggests that you can withdraw 4% of your portfolio each year, adjusted for inflation, and not run out of money, even with those market ups and downs.
So it's like a safe withdrawal rate.
Exactly. It's a guideline, of course, not a hard and fast rule. Your actual withdrawal rate might be higher or lower depending on your individual circumstances.
Right, your risk tolerance, your life expectancy, all those factors.
Exactly. But it's a good starting point for planning, for understanding how much you can safely withdraw without depleting your nest egg.
Okay, that makes sense. And what about Social Security? How does that factor into the equation?
Well, Collins acknowledges the concerns a lot of people have about Social Security's future. Will it be there for us? Will it be enough?
Yeah, those are big questions for sure.
Right. And while the system definitely faces challenges, Collins argues that it's unlikely to disappear entirely. However, he also cautions against relying on it as our sole source of retirement income.
So plan for the best, but prepare for the unexpected.
Exactly. It's always wise to have multiple streams of income in retirement.
Right, don't put all your eggs in one basket, so to speak.
Precisely. Now, one of the things I really appreciate about Collins' approach is that it's about so much more than just accumulating wealth.
Oh yeah, definitely. He talks a lot about aligning your money with your values, right?
Exactly. He shares this great story about how he started donating a dinner for 10 to his daughter's school, and how that small act of generosity turned into this big celebration for the whole community.
Oh, I love that story. It's a reminder that money, when used intentionally, can be a powerful force for good.
Absolutely. And he even talks about practical ways to do this, even if you don't have millions to give away, through things like donor-advised funds.
So it's not just about accumulating wealth for ourselves, it's about using it to make a positive impact on the world around us.
Exactly. It's about finding that balance between enjoying the fruits of our labor and giving back to causes we care about.
So we've covered a lot of ground in our deep dive into the simple path to wealth. We've talked about debt, investing, those big, ugly events, retirement planning, even philanthropy. What are your final takeaways for our listeners?
For me, it boils down to a few key principles. First, simplify your finances. Don't try to outsmart the market. Don't get caught up in all the complexity and jargon. Focus on low-cost index funds, the power of compound growth, that long-term perspective.
Keep it simple, keep it low cost, keep your eyes on the prize.
Exactly. Second, be intentional with your spending. Align your spending with your values. Figure out what truly matters to you and make sure your financial decisions are supporting those values.
Don't let your money control you, control your money.
Right. And finally, remember that financial independence is about more than just money. It's about freedom. It's about security. It's about living a life that's aligned with what you truly value.
It's about designing a life you love.
Exactly.
Huh.
And the Simple Path to Wealth provides a roadmap for doing just that.
Absolutely. It's a fantastic resource for anyone who wants to take control of their financial future and start building a life they love.
Couldn't agree more.
Well, there you have it, folks. Our deep dive into the simple path to wealth. We hope you found it insightful, informative, and maybe even a little bit inspiring.
We had fun.
We did. And remember, the path to financial freedom might not always be easy, but it's definitely worth taking. So keep learning, keep growing, and until next time, keep investing in yourselves.
Play here.